Today we're talking about LEEF Brands, and I'll be honest, this is one of the most materially bullish corporate moves I have seen from them yet. They just announced the full early conversion of over USD 10.5 million worth of 11% secured convertible debentures, and this changes the entire trajectory of the company going into 2026. I'm going to break this down because most people don't understand how big this is. This isn't just another press release. This is a structural shift in how the company is financed. Here's the simple version. LEEF had 11% secured debentures that were sitting on the balance sheet until 2027. High interest, heavy, restrictive, a real handbrake on growth. And instead of waiting 2 more years and paying out millions in interest, the debenture holders, the people with the leverage, said, "We want equity instead." So they converted everything early into 59.2 million units at Canadian 25 cents. Each unit has 1 common share and 1 full warrant at Canadian 30 cents for 36 months. And here's the thing that I love. The CEO himself converted his entire debenture and rolled in nearly another $1 million of notes payable at the same time for the same terms. That's not marketing, that's conviction. Why is this massively bullish? For one, the 11% debt is gone, completely gone. This single move removes one of the biggest barriers for any cannabis operator: expensive legacy financing. Most companies in this industry are drowning in debt. LEEF just eliminated their largest chunk of it. No more 11% drain, no more refinancing risk, no more overhang. 2, a much cleaner balance sheet heading into New York and California expansions. What's left now is basically a small real estate note at 4% and another one at 0% interest. That's it. This is the kind of balance sheet you actually want going into an expansion cycle. 3, insiders choosing equity is one of the strongest signals you can get. Debenture holders could have just sat there, collected interest, and had downside protection. But they didn't. They converted early, they took shares and warrants, the CEO voluntarily added even more. This isn't a group that's looking for 10% yields. This is a group that is betting on the upside. 4, yes, there's more shares, but now incentives are aligned. Dilution only hurts when it goes into weak hands. This went into insiders, strategic lenders, long-term supporters, and people who want the stock price higher, not lower. The Canadian dollar 25 cents conversion price also anchors market psychology. If sophisticated capital is converting at that level, it matters. 5, it dramatically improves LEEF's story for institutions. When you go to raise capital or bring in a strategic partner or negotiate with distributors, a messy balance sheet kills the conversation. A clean one does the exact opposite. It attracts deal flow. This makes LEEF a much more investable story today. Now, this didn't happen in a vacuum. Management is coming off 24% year-over-year revenue growth, gross margins that doubled in Q3, a new high-margin revenue stream from New York, and expansion in California through Salisbury Canyon Ranch. So why convert now? Because the company is entering a growth period, and institutional capital becomes possible once the balance sheet is cleaned up. This conversion is a setup move for the next chapter. Here's the way I see it. This is the strongest signal we've had yet that LEEF's management and lenders believe that equity has more upside than downside. The company is executing. Margins are improving, growth is coming from multiple states, and now the capital structure finally matches the opportunity. This is how turnarounds start, with confidence from the people closest to the numbers. Whether you are already a shareholder or looking at LEEF for the first time, this press release should be on your radar screen. With that being said, thank you for watching and see you next time.